You wake up, check your phone, open your banking app, and it just loads. And loads. Then a message appears. Services temporarily unavailable. You try again. Same thing. You try a different browser. Same thing. You call your bank. The hold music plays for 11 minutes. And somewhere in the back of your mind, a very quiet, very uncomfortable thought starts to form. What if this isn't a glitch? This has already happened, not in a dystopian film, not in a conspiracy subreddit, in real life, to real people, in countries that looked perfectly stable, right up until they didn't. Cyprus, 2013. Greeks woke up to find ATMs capped at €300 a day, overnight. No warning. Argentina, 2001. The government froze all bank accounts for 12 months. They called it El Corralito, the little fence. Charming. India, 2016. The government voided 86% of all paper currency in circulation with 4 hours notice. And in the United States, March 2023, Silicon Valley Bank, one of the top 20 American banks, collapsed in 48 hours. So, let's talk about what you'd actually do, not the panicked version, the smart version. Because if the system ever freezes, the order in which you move your money matters more than how much of it you have. Before we get into the playbook, let's understand what actually happens when a bank shuts down. Most people think of bank failures the way they think of a store closing. You just can't shop there anymore. That's not how it works. When a bank goes under, it doesn't just close, it freezes. Every account, every transaction, every direct deposit, suspended, pending government intervention. In the United States, the FDIC, Federal Deposit Insurance Corporation, steps in. They insure up to $250,000 per depositor, per bank, per ownership category. That sounds like a lot. For most people, it covers everything they have. But there are two problems with just trusting that number. First, even when the FDIC is working perfectly, you can go days or weeks without being able to access your money. The average FDIC resolution took 99 days in the 1980s banking crisis. These days, it's faster, but faster can still mean a weekend with no cash. Second, the FDIC currently has enough reserves to cover about 1.3% of insured deposits. 1.3%. If multiple large banks failed simultaneously, the FDIC would need a congressional bailout just to operate. That's not speculation. That's how it worked in 2008. So the insurance exists. The safety net is real. It's just not instantaneous, and it has limits no one talks about. So what's the smartest order to move your money if you see this coming, or if it's already happening? Here it is, step by step, roughly in priority order. Step 1. Cash. Physical. In your hand. This sounds like advice from your grandmother's Depression-era playbook. That's because it is, and it's still correct. The single most immediate vulnerability in any banking crisis is the payment system. Cards stop working, ATMs run dry. Venmo and Zelle depend on bank rails that may be frozen. Cash is the only payment method that doesn't rely on a functioning bank. No internet, no approval, no third party. The question is how much? Financial planners typically say 1 month of core expenses. For most households, that's somewhere between $2,000 and $5,000, depending on where you live. Small bills matter more than large ones. A $100 bill is useless if a nervous gas station attendant won't make change. And obviously, secure storage. Not under the mattress. A fireproof safe, ideally bolted down. Step 2. Multiple banks, different institutions. If all your money is in one bank and that bank freezes, you're frozen with it. The fix is preemptively simple. Spread your deposits across at least 2 unrelated institutions. A regional bank is not the same as a credit union. A credit union is not the same as an online bank. A brokerage with a cash account is different from all three. The FDIC's $250,000 limit also resets per institution. So if you have $500,000 in deposits, splitting it evenly across 2 unrelated banks gives you full insurance coverage on both halves. But here's the part most people miss. Even under the same institution, different ownership categories get separate $250,000 limits. Individual accounts, joint accounts, trust accounts, retirement accounts. Each is a separate bucket. This is completely legal, completely sanctioned by the FDIC, and almost nobody uses it. Step 3. Treasury bills and money market funds held at a brokerage. Here's where it gets interesting. Treasury bills, short-term U.S. government debt, are not bank deposits. They are not covered by the FDIC because they don't need to be. They're backed directly by the U.S. government. When you hold T-bills through a brokerage account, that money sits in a separate custodial structure from the brokerage's own assets. If the brokerage fails, your T-bills are still yours. SIPC protection adds another layer, up to $500,000 in securities. In a banking crisis, T-bills held this way tend to be among the most stable, accessible assets a person can own. The current yield, as of early 2025, 3-month T-bills were paying around 5.3%, better than most savings accounts, and arguably safer than most savings accounts too. Money market funds invested in government securities work similarly, though they carry slightly more complexity. Not all money market funds are equal. You want one that holds exclusively US government securities, not corporate paper. Step 4. Hard assets you can actually use. This is where people start getting into territory that sounds extreme but has a long, boring history of being correct. Gold and silver have been a store of value for over 5,000 years, not because of mysticism, because of math. They can't be printed. They can't be devalued by a policy decision at 2 a.m. Physical gold, coins, small bars, held outside the banking system is genuinely inaccessible to a bank freeze. It exists whether or not the ATMs work. The caveat: selling it quickly isn't always easy, prices fluctuate, and storage has real costs. This is not a primary strategy, it's a backstop. Silver, interestingly, is often more practical for day-to-day transactions if things ever got that dire. A 1-ounce silver coin is worth around $25, far more negotiable than a gold coin worth $2,000 if you're trying to buy groceries. Real estate is another form of hard asset. Your house doesn't disappear when a bank fails, but it's also not liquid, and a mortgage that suddenly hits a frozen servicer has its own complications. Step 5. Know your digital options, carefully. At some point in this conversation, someone always brings up Bitcoin. It's worth addressing honestly. Bitcoin and similar cryptocurrencies are genuinely not dependent on the banking system. They run on a decentralized network that no single government can simply switch off. In countries experiencing currency crises, Venezuela, Turkey, Lebanon, crypto has served as a real alternative for some people. But, and this is a significant but, most people hold crypto through exchanges. Exchanges are not banks. They are also not insured. When FTX collapsed in 2022, $8 billion in customer funds vanished. The people holding Bitcoin on that platform owned a claim on a bankrupt company, not a Bitcoin. If you're going to hold crypto as part of a crisis hedge, the only version that makes theoretical sense is self-custody, your private keys on hardware you control, not at an exchange. That comes with its own risks. Lose the seed phrase, lose everything. There's no FDIC for forgotten passwords. Let's zoom out for a moment and look at what the actual numbers say about how prepared the average person is for any of this. According to a 2024 Federal Reserve survey, 37% of Americans couldn't cover a $400 emergency expense without borrowing or selling something. Not $4,400. The median American household keeps roughly $8,000 in checking and savings, all in one institution, almost never diversified. So for most people, the playbook above reads as theoretical, abstraction. But here's the irony. The steps that protect you most in a crisis are the same steps that make you financially healthier in normal times. A cash reserve protects you from a bank freeze. It also protects you from a car repair. Multiple accounts spread across institutions protect you from a bank failure. They also protect you from fraud, account closure, and banking errors. Treasury bills yielding 5% protect you from bank insolvency. They also pay you more than most savings accounts. The crisis hedge and the sensible financial plan turn out to be the same thing. The people who think about the worst case are often quietly better positioned for the ordinary case. Now, let's be clear about what this is not. This is not a prediction that banks are about to collapse. The US banking system, for all its flaws, is among the most heavily regulated in the world. The FDIC has resolved over 500 bank failures since 2008 without a single depositor below the insured limit losing $1. There is a certain corner of the internet that has been predicting imminent financial Armageddon for roughly 40 consecutive years. At some point, the track record matters. And yet, black swan events by definition happen. The 2008 financial crisis was called impossible by the people running it. SVB's collapse was called unlikely 3 weeks before it happened by the same analysts who covered it. The question isn't whether you expect the system to fail. The question is, what does it cost you to be prepared? And what does it cost you if you're not? Diversifying your deposits costs nothing. Keeping a cash reserve has an opportunity cost, but a minor one. T-bills are paying you real money to hold them. The asymmetry is unusual. The downside of preparing for something that doesn't happen is small. The downside of not preparing for something that does happen can be catastrophic. There's a detail buried in the history of bank runs that doesn't get enough attention. In most historical banking crises, the people who were hurt the most weren't necessarily the ones with the least money. They were the ones who acted last. In Cyprus, the early movers, the ones who sensed something was wrong and quietly withdrew funds before the capital controls hit, largely protected themselves. The ones who assumed everything would be fine, who trusted the system, who waited, found themselves on the wrong side of a fence they couldn't see being built. Here's the uncomfortable part of all this. The banking system depends fundamentally on trust, not on assets, not on regulations. Trust. A bank run isn't caused by a bank being insolvent. It's caused by enough people believing the bank might be insolvent, which then makes it insolvent. The system is, in a real sense, a collective story we're all agreeing to tell, and stories can change very fast. SVB went from perfectly healthy to completely collapsed in less than 48 hours. The exact mechanism was a tweet, then a Slack message in a venture capital group chat, then a bank run. 21st century bank failures don't announce themselves with lines around the block. They happen in group chats before breakfast. So the question this video leaves you with isn't really about banks. It's this. How much of what you believe about your financial security is based on something solid, and how much of it is based on a story that everyone around you has agreed to believe? Worth sitting with. Worth maybe doing something about.